In your 40s, retirement may seem a ways off, but looking at these 5 financial planning strategies may bring it more into focus. So first we have investigating a Roth conversion. And then second, we're gonna look at creating an emergency cash fund. Third is sharpening your investment approach. Fourth, we're gonna look at setting up a health savings account. And then fifth, we're gonna look at paying off debt. So hello, my name is David and welcome to Whiteboard in the Wilderness. And by the end of today's video, you will have learned that Roth accounts grow tax-free, cash reserves provide financial flexibility, what consistency has to do with investing, the impact of HSAs, and a few debt ideas. Gen Xers see retirement on the horizon, albeit maybe a distant horizon when you are in your 40s. Staying on track with your investment and planning goals is critical. Planning and money management are critical in your 40s because of longevity risk or running out of money. Planning and investment strategies differ for everyone, and it becomes easy for small investment mistakes to become magnified into big ones. That can be where guidance from an experienced professional like myself can help. Let us get right into it. So first, let's look closely at the Roth conversion opportunities while you're in your 40s. A Roth conversion is when a person moves money from a traditional retirement account to a Roth account, which results in a taxable event because you are transferring money from an account where you would have paid your taxes later to a tax-exempt account. After a conversion, assets in your Roth account will grow tax-free and withdrawals in retirement are tax-free as well. This topic is not always straightforward because doing a Roth conversion is in a particular tax year can involve multiple factors. One factor is expecting higher or lower tax rates during retirement. Predicting what taxes will look like in the future is impossible. So anticipating this can be extremely difficult, especially for someone in their 40s whose retirement could be potentially 30 years from now. Also, you need to consider if an individual has the available money outside of their retirement accounts to pay the income taxes that will be due when the Roth conversion happens. It is wise to coordinate with a financial planner and an accountant at least once a year to decide if a Roth conversion would be helpful. So number 2 is setting up and maintaining an emergency cash fund. Although these assets such as a checking and savings or money market account are not designed to be growth vehicles, they still play an essential role in retirement and also in retirement planning. Having a solid liquidity position in your 40s can help you stick to your financial plan when unexpected financial obligations arise. The dollar amount that you keep in your emergency fund will vary, but we will all face some unanticipated event that impacts us financially at some point in our lives. Examples can include a car or home repairs, a job loss, and the support of a family member. Emergency cash reserves provide financial flexibility to address these situations without interrupting your regular retirement savings and savings contributions. Also, maintaining a stable cash position during retirement is very important for the same reasons. They might differ slightly, but unexpected events such as higher healthcare costs will still occur during these years. So number 3, have a disciplined and consistent approach to investing. Whether you have amassed a sizable amount of savings and investments over the years or you're just getting started, people in their 40s should focus on disciplined investing and a disciplined investing program No matter the amount, the consistency of the investment contributions can genuinely build wealth by taking advantage of compound interest. For example, suppose an individual is age 40, has accumulated $150,000 of retirement savings thus far, and decides to invest $10,000 annually to this account for the next 30 years. Assume growth rate of say 7%. In that case, they will have approximately $2.2 million in retirement. Even further, take this same example, but assume there is then no money saved for retirement thus far. If this person committed to the same amount of investing in that program, investing $10,000 per year over that 30 years, they would still have $1 million despite starting with zero. This scenario shows that it is not too late to begin investing in your 40s. The key is just getting started if you have not done so. So number 4, invest money in your health savings account. For those who have access to a high deductible health care plan, a health savings account, also known as an HSA, could be a vehicle to consider if it makes sense for you. For your specific financial situation. HSAs are used to pay for out-of-pocket medical expenses. So someone can use these funds now or years later during their retirement. In other words, this can be an account expressly set up to cover retirement medical expenses. Even more impactful, HSAs provide tax advantages. Individuals' contributions are tax deductible. The accounts grow in a tax-free if withdrawals are used for qualified medical expenses. And so that is great. So number 5 is focus on paying off debt. So most people in their 40s will not have their mortgages paid off. But if an individual maintains other types of debt, it is prudent to start making a consistent effort to get all of it repaid. Examples include credit card debt, car loans, and student loans. As a younger Gen Xer, you may still have some residual student loan debt and also have to start saving for your own children's college. Now may be one of the best times to sit down with a financial planner and develop a strategy. So debt hurts free cash flow. So it is essential not to bring these financial obligations into your retirement. One pillar of retirement planning involves evaluating and creating streams of income for the retiree. Debt can increase and create unnecessary stress and not allow you to enjoy this income during your retirement years thoroughly. So one of the main reasons we provide these videos is to educate and inform you, especially our Gen X clients. There are many focus areas for financial planning. We want to break them down into bite-sized pieces. Many times when you plan for the unexpected, the emotional and financial stress is significantly lower than if you did nothing at all. It is impossible to avoid every unforeseen situation, but we have seen and witnessed firsthand the power of financial plan. Thank you very much, and we hope you have a great day. So we'd love to hear from you, so please subscribe to our channel and like us if you enjoyed this video. At the close of every video, we will give you a quote from my favorite TV show called The Office. And we want you to guess which character said the line. And there's even extra credit if you can name the season and episode. So please email me at david@livingyourwealth.com with your answer. Did one of you tell Stanley that I have asthma? Because I don't. If this gets out, they won't let me scuba. If I can't scuba, what am I working toward? I don't even know how to answer that one, but it's okay. Thanks very much and hope you have a great day. Thank you. Bye.